This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Tom Lambeth from VP Capital, mate, great to have you back on Talk Your Book. We'll get into your stock pick in a second, but maybe just talk us through a little bit about VP Capital, what you guys look to invest in and how you guys have been going over the last 12 months.
Thanks, Chris, and pleased to be back. So VP Capital is a fund manager which was started 3 and a bit years ago by myself and one other fellow predominantly. Its IRR over time has been 24% per annum since inception. So it's very nice. We predominantly look at small to mid cap equities, but we've got a very sort of opportunistic approach. So we can do long, we can do short. Basically anything that makes money, we'll look at.
And what stock do you want to talk about today?
A stock called Prospa, as distinct from Prosper, which is some viewers may be familiar with, which is the US-based Silicon Valley peer-to-peer lender. This is Prospa, the Australian ASX-listed company founded in 2012.
And give me the helicopter view of Prosper and what their business model looks like.
Yeah, sure. So Prosper are, I guess, a part of this emerging trend that we've seen over the past 10 to 15 years, which is neo-lenders, they call themselves. Prosper's business is lending to small businesses in Australia. And what they look for is businesses, generally with turnover more than $50,000 per year. And they've been relatively successful in growing their business over the past 9 years. They listed a few years ago at a much higher share price than it is today. But put simply, it's lending to mum and dad businesses, hairdressers, trades, consultancy businesses, hospitality. Their book's pretty diversified across sector and geography.
And where do they get their funding from?
Yeah, so most of the funding is by a securitization facility. So it's all off balance sheet, which we like, which means that the lenders or the funders to Prosper's business have limited recourse to Prosper Headco. And that's all in a facility which is backed by banks and larger investors. But certainly some onshore banks and some offshore banks would look at it.
And you mentioned the typical customers, sort of a mum and dad type business. Do they usually come and get one loan, pay it back and that's it? Or are they usually repeat customers?
Look, a large percentage of their customers are repeat, more than half, we believe. It's the type of business which lends itself to building relationships over time. So you would expect a large repeat customer, but also their growth is also driven by winning new customers. So I think it's roughly half if you look at the growth numbers.
They've got a really high net promoter score, don't they? Is that something you find a relevant data point, or do you view that a bit wishy-washy?
Look, it's probably a little bit wishy-washy for us, but look, some people do believe in just breaking down the basics and looking at customer love, and which feeds into unit economics. And we know that it's been spoken about a lot with Afterpay, for instance. So I'm not completely dismissive of it, but the reason why we like this business is not because of the net promoter score. It's because of more fundamental, kind of tangible reasons, which we're going to speak about.
And they got smacked around in COVID a bit. Talk me through what happened to their business during COVID, and particularly through the lockdowns, both nationwide and later on in Melbourne, and maybe what originations look like now after going through that tough trough.
Yeah, sure. So what happened is they moved pretty quickly, and what you saw is a reduction in gross loans written in 2020, and as you expect. The consequence of that was, I guess, growth dropped off, but equally your cash flows were very healthy. So what you were left with was a book that was spinning off cash, and without any kind of reinvestment into growing the loan book. They cash flows from operations. I think they made more than $30 million in FY20, which was very healthy. By the way, the enterprise value is 50, so which puts it in perspective. So then post-COVID, we saw obviously I guess a bit more risk appetite. They did, probably a bit conservative. They over provisioned, we think, in 2020. I think around 10% of their receivables are booked as likely bad debts, which we think is too high.
What do you think that's closer to?
Well, I think if you look at the business over the last 9 years, it's been around 5%. The board have a target of between 4 and 6. We think that given the macro backdrop, we think it's likely to be in that range. And so I think that's kind of a catalyst for us, which is one of the reasons we like it. But coming out of COVID, they've managed to, I guess, steer the business back to writing more loans, and we expect that to continue. So right now they're kind of back where they were almost from an origination perspective.
And what other data points in a business like this do you really dig into?
The valuation for us and versus the growth, just at a high level, this is a business that was growing at 30% plus in 2018 and revenue growth, and even higher before then. So, if you break it down and say, well, can they get back to that level? Because the problem is, I think the markets penalise it by maybe a perception of being ex-growth, which I guess it has been in the last 12 months. But if you believe you can get back to 30% plus, now keep in mind there are 1 million small businesses in Australia which they target out of a total of around 2 million. So the addressable market's massive, and if you say the average loan size is 20K, it's a $20 billion market, and so they're less than 1% penetrated, in other words. So we think that there's enough runway for them to grow their book and grow revenue. That's what we look for. So we're looking for a return to growth, a return to active customer growth and revenue growth, and we think that the valuation, which I mentioned, is 140 of market cap, 90 of cash, gives you 50 enterprise value. I think it's very cheap.
And so you mentioned also before, you touched on Afterpay and their wild success in the buy now, pay later market. And if you look at Afterpay, that success was really born out of incredibly high credit card fees that the banks were charging, and that opened up an opportunity for them. When you look at commercial banks in Australia, they've been reticent to lend for non-home loans really since the GFC. Do you think that's opened up an opportunity for groups like Prospa that can now exploit that and really take that market share away from the banks in this space?
Yeah, absolutely. I think there's probably 2 reasons why Prospa has been able to capture some of this market. The first is, they have probably a tech advantage versus the banks. They're nimble, their process is, probably more developed and simpler. So I think often a potential borrower can get approved within hours, not days and weeks with the bank. The second reason is, one of the bank's not incentivized to go after this market because of the capital adequacy rule. So it's easier to write a mortgage where I have to pledge, less equity capital against that mortgage versus, pledging equity capital against an SME loan. So the rules and the structure of the system don't incentivize the banks, put simply, and that's always left a massive hole in the market where as you've seen in the last 9 to 10 years, other lenders like Afterpay and in this particular sector, Prospa, has filled.
And in terms of maybe what's viewed as good debt for society and bad debt, like debt that is being provided by Prospa is largely productive debt. It's going into employing people and growing the economy more broadly, and I guess should be viewed more favourably than debt that's just provided to people who are buying a second investment home. Do you think there's the potential for the government to really get behind groups like Prospa, because this is sort of the lending that really goes to growing employment opportunities and growing the GDP even economy?
Yeah, I think that's right. There are 2 sides of the coin here. I think, Prospa say that there's a 4 times money multiplier on their lending, which is, that's to say that a dollar lent gets you $4 of GDP. So from a government perspective and a broader society perspective, that should be a net positive, as you imply. I think the other way to look at it is, they do need to be careful in, I guess, some of the, there are some groups which argue the interest rates are too high, and if you look at their net interest margins, they are pretty fat. your rates can go as high as kind of 30%. It's not arguably, a deal's a deal. It's not necessarily predatory, but they need to watch that aspect of their business to make sure, they're not sort of acting irresponsibly, I think.
Could you see a change to their business model, the way they calculate the interest, like some of those consumer buy now, pay later lenders have done, where it's not so, doesn't become such a debt spiral for the businesses that take on that debt?
Look, not at this point. I know they were, subject to an inquiry a few years back, around the time of the Royal Commission, and they did satisfy the powers that be, the regulatory bodies, that they weren't predatory lending, and in particular, I think with some of the late fees that they were applying, I think there were some adjustments to that, Chris. So, look, our view is there's no risk there in the short term, but just something to watch.
And I know you've got a keen eye on the macro outlook as well. How do you view a steepening or a potentially steepening yield curve impacting a business like this?
Yeah, well, firstly, on the macro outlook, it's the other reason we like this business. I think if you look at consumer confidence, it's cyclically high. You've got household savings rates are also very high. Interest rates obviously very low, and so that macro backdrop coming out of a lockdown, I think is going to be there for the short to medium term. So it's actually the time of the cycle you want to own a business like this, unsecured lender. So that's kind of a big tick in our view in the short to medium term. The yield curve, your point about that. Look, I think yes, but you've got, most of the margin is based on credit risk, and it's not.
Margin's already big enough by the sound of things without trying to increase it from a yield curve perspective.
That's right. If you look at it, the yield, if your base rate goes up by 1 or 2% as a percentage of your total net margin, it's not massive compared to, say, a bank. A bank is going to be a bigger beneficiary, I think, if yield curve changes.
And so what happens with these sorts of businesses? There's a lot of them floating around that are listed at the minute. Do you see consolidation? Do some of the banks decide to pick some of them off and get some of that expertise back in-house? What do you think plays out for the industry from here?
Look, possibly. You never know with M&A. You kind of look like a fool trying to guess most of the time. Our view is there's enough organic growth for Prospa and Co. just to keep growing. As to whether banks get into the sector, keep in mind the banks are investors in the securitization facility, and so they're getting 5.5% on their money. So you can argue they're somewhat involved anyway. Whether they want to own the equity is probably a different story.
And there's a reason why they're not doing these sort of loans in the first place, as you touched on, isn't it?
Exactly. Yeah, it's not economic for them. The opportunity cost of doing SME lending is high. You could just focus on mortgages.
This is a bit of a broad-ranging question, and it's off topic a little bit. But do you ever see a world where there are mandated different interest rates for different things? So whereby a first homeowner, the government will mandate they get a 0% interest rate for the first 3 years of their home loan. If it's a business lending for productive debt purposes, they get a subsidised interest rate, and if someone's getting a loan for non-productive debt, e.g. a second investment house, they're mandated to pay a higher rate. Do you think a world's going to exist in our lifetime where these sorts of interest rate policies get implemented?
Possibly. The problem with executing something like this has always been, I guess, the execution part of it. How do you stop someone from rorting the system? What's to say my business is not productive versus the next guy? And maybe I'm a first home buyer if I can prove it from a documentation perspective. And these have always been the problems with enlarging bureaucracy and making more complicated systems. I think if you could somehow delineate that on a micro scale, then possibly. I know some people in the crypto space have been talking about that as some of the possible benefits of crypto, the tokenization of the world. But we don't factor that into our view on Prospa, of course.
I'm trying to reduce the amount I speak about crypto, Tommy, so I won't go down that rabbit hole with you. But mate, thanks very much for coming on. It's a brilliant thesis as always, and really appreciate you giving us some of your time.
Thanks, CJ.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.